Hey, Kevin, you want to go ahead and introduce yourself to the participants?
Howdy, everybody. My name is Kevin Kimmel, and I'm with Brady Chapman Holland and Associates.
Okay, so right now the situation that, and I'm just letting people in as I speak. So right now the situation that we have is that we are about 3 months away from having to renew our HOA insurance. So in the past, our HOA insurance was covering the roofs, everything, the paint out, and up to the last few years, it worked really well. Hold on, people are asking me what meeting. 1 second. And up until a few years, it worked really well for us. Unfortunately, in the last few years, we have experienced drastic changes in the price of our insurance. So let me go ahead and quickly go over the problem that we have, and I'm going to overview quickly the situation that we have with our HOA insurance, and then we'll let Kevin answer our questions. Okay, can you guys see my screen?
Yes.
Yes.
Okay. So let me, for those of you, especially who are fairly new to the HOA, I know that a couple of people here are just joined our HOA this year. Let me quickly give you the overview of the problem that we're experiencing. So our current situation is as follows. And you can go ahead and start reading. I'm still answering questions from people. So in the last year, and I'm only going to go over the insurance that we have in 2023, starting from March 1st, 2023, and now. Our down payment for this year was $31,000. We really struggled to collect the funds by not paying any of our suppliers for about 3 months. All of our suppliers' money were frozen in order for us to collect $31,000. And it took us several months to catch up to payments to our suppliers. We also could not perform any roof repairs during this time. We were basically collecting money for the down payment. The cost of insurance in 2023 increased from the previous year. Comparing to 2022, it increased by $11,000 per year, or about 12% year over year on the monthly costs. So our current cost of insurance is monthly insurance is $6,300, just like a few dollars short of $6,300, which is approximately 62% of our monthly expenses for the entire, all the funds collected. Or the cost of our HOA insurance is currently approximately $181 per unit per month. Now, I will clarify that that is the total cost of insurance, not just property insurance, but also insurance such as errors and omissions, crime, and a couple of other small policies. The problem that we encountered this year, so in all the previous years, we have had at least one thing that was going for us. In all the previous years, we had a wind and hail buyback policy that we were able to purchase, which means that in the event of a wind and hail, we could potentially use the policy in order to buy down our deductible to approximately $25,000. Now, in the past, and up until last year, our deductible was 2%. In 2003, this year, it went from 2% to 5% deductible. So that means that at this time, if we had a significant loss event, for example, all our roofs needed new covers for hail or wind damage, it means that our total deductible would probably need to be close to $450,000, pretty much $500,000, in order for us to even start the repairs on the roof. And because we were not able to purchase the wind and hail, so the cost of wind and hail buyback increased significantly, to the point that it was almost doubled what it was previous year. Previous year, it was pretty much very expensive. We barely could scramble money to buy the wind and hail buyback. with the cost of wind and hail buyback doubling this year, we were not able to afford the wind and hail buyback. So let me translate it to you in what it means in terms of like normal speech. If we had a wind and hail event that left our roofs destroyed, as of right now, we would have to collect from our homeowners, which is a total of 46 units, $450,000 in deductible before we could even start to engage our insurance. Correct me if I'm wrong, Kevin.
So your insurance could still respond. They would send you a payment less your deductible. So you might be able to start getting it, but you wouldn't have, they would depreciate it based upon the deductible.
And also we would have a depreciation on top of everything.
They all claims would start out as actual cash value, and then if replacement cost is triggered, once you exceed what they consider actual cash value and you submit supplemental invoices going over what they initially gave you, they would pay more if the replacement cost factor was triggered.
Correct. So can you explain what depreciation is? Because right now our roofs were put in 2012. Can you explain the issue with depreciation on top of not having the wind and hail?
Yeah, so depreciate, there's two coverage terms in property insurance that are commonly used, and replacement cost, which is essentially they're going to replace it at the cost less your deductible for like, kind, and quality. Then there's what's called actual cash value. Actual cash value is replacement cost less depreciation. Carriers also have since started adding roof limitation endorsements where they will revert the coverage from replacement cost to actual cash value when your roofs exceed a certain year term. So if your roofs were last replaced in 2012, and if there's a 10-year roof limitation, then your roofs would be adjusted at actual cash value, factoring depreciation. Some
In
carriers are
human
10,
terms,
some are
it would
12,
mean
some are
that,
15. So it just depends on the carrier.
but in human terms, it means that instead of getting a full value, which is the total, replacement, whatever they told us the roof would cost, you would, let's just say that they told us that the total cost of replacement of the roof is 500,000, out of which 450 is our deductible. And then how much approximately would they actually depreciate the roof?
So that's all going to depend on at the time of loss.
Okay.
And the adjusters are going to look at age and what they factor from the time the roof was put on, deterioration from sun, etc. So you can't really justify a number to it today. It is
Gotcha.
as of the time of loss.
But the point is that let's just say that the roof of $500,000, let's just say the total cost of roof is $500,000. If our roof was 2 years old, we would get $500,000 minus our deductible. But because
Exactly.
the roofs are 10 years old, we would get actually less than $500,000 to start with.
If they said, it would be 50% depreciated, then you can essentially say, okay, well now we only have 250,000. So with
Out
our
of which
deductible being
450 is our
450, it doesn't
deductible.
even make sense to turn in a claim. Exactly.
Does
So I have a
anybody,
question, Kevin. Is our current policy, I'm assuming you looked at it, is it ACV or replacement cost? Because you can't you pick which one you want?
So most carriers, and I have looked at a certificate. I haven't gone through your whole property policy. I am actually not your current agent, so I've just started working with the board. But the policies that we offer to all, and this is for all condos and townhomes that don't fit a standard market. So what that essentially means, the standard market would be the ones you typically see on TV, Travelers, Hartford, Philadelphia. Most of them have gone away from insuring condos and townhomes. So we go through a broker for excess and specialty carriers. All the excess and specialty carriers have roof limitation endorsements on them. And so while the coverage will apply replacement cost for if you had a fire, if you had a vehicle hit your building, any covered cause of loss outside of when it comes to roofs, the carriers will add a roof limitation endorsement that will revert the coverage from replacement cost to actual cash value if your roofs are older than a certain year. And again, usually that's 10, 12, or 15 years. But if you plan from a capital improvement perspective to update them accordingly, as long as we can show them, hey, it's been updated as of X date and we're within the limitation, then you have replacement cost coverage. If you exceed that limitation year, that's when the depreciation would kick in and it would be actual cash value.
And that's just put into, is that just written into the policy somewhere?
Yes, exactly.
Because I'm looking at, Elena sent me the property insurance EOI, and this says it's a 3% deductible. Wind hail, it says $8 million, 3%.
The information that we received from Eric, but it was 5%. Now, I did not
Let me see if I can pull it
I
up.
do not know how to verify, but he said it was 5%.
Yeah, the accord sheet shows wind hail 3% TAV 100,000 minimum. So I don't know if there's just conflicting or whatever, but
Do not know. But anyhow, if you don't mind, let me go ahead. So I just took myself off share because I cannot see people joining when I'm sharing for some reason.
okay. So I don't, Kevin, do you have the same one or?
I'm trying to pull it up. We have Amazon Workspaces, and for whatever reason, you can't do Zoom within it. So I sent everything to an email so that I could log out of our office. So I'm seeing if I can pull it up quick.
Do you want me to? I can share it. Do you want me to share screen, Elena?
Can you share now, or do I need to add you as a host?
No, I can share it.
Okay. And here's the thing: the certificate. If there's one thing you take from tonight, is just a piece of paper that an agent issued at a certain date and time. And if it's wrong, it doesn't. This thing doesn't matter. You have to really go to the policy.
Yeah.
But so what he's saying here. Here we go. It breaks it down here to the wind hail is 3% of the total insured value. At that 8 million number. Is that the current year certificate? You might.
Yeah, this one says it goes to the 2024.
Yeah, sure does.
What is our total value? Does it show?
Right here, 8 million.
8 million. Which is what the statement of value showed.
Yeah, so this so the deductible, it looks like is this, so I guess the basic deductible is 25,000. I assume that's all other perils except for wind hail's 3%, according to this. So yeah. Okay. So that's something that probably needs to be
Verified.
yeah, because the
Elena?
UI says
Elena, this is Glenda. Where did you get the 5% if this certificate says 3?
From Eric. Eric said it was 5.
But he signed this certificate that says 3.
He said 5 to us when we were discussing it.
Well, then
We need the correct information.
Okay, so the correct information would be in the policy then.
Well, who has the policy?
Kevin had the policies. I forwarded to him.
Can you forward it to us?
I think I already did. He already requested it, and I forwarded several, like at least once, with a bunch of policies.
Did you receive it? Glenda didn't receive it.
It was a while ago when we first renewed it last year.
I'm looking
Would
see
you
if I
email
have,
it to us?
Yeah. Do you remember which option you selected? Because I have that pulled up. This one isn't the signed one.
Okay, it was some kind of a B,
Option 2.
or what did we
It was a yellow colored on that spreadsheet. So I have all the options here.
Hey Michael, do you remember which one you said that it looked like aligned? I think it was 3D or something like that.
Yeah. I'm just trying to see if you sent me the actual policy, I see the liability policies. I don't know if I see the general
I
property.
sent you everything that we
Same.
had, all the document that I had.
Yeah, I didn't, let me see. There's the umbrella. That's the GL. Certificate. Let's see, there's your DNO, crime. Finance note.
So while they're researching that, so the problem that we currently
Okay.
have, is that with the current policy, let's just say that unit
I found
611 roof leak, and your unit 611 roof is really leaking right now. In fact, their ceiling has collapsed in. So let's just say that we know that the cost of repairs for 611 is approximately just the roof, not interior, just the roof. Let's just say we know that's approximately $4,500, $5,000. And we have a total of about $12,000 in our bank account. For us, we have no ability to trigger insurance for 611. Because if we triggered insurance for 611, the cost of repairs is, let's just say $5,600 or $4,600. And our deductible is how much if we triggered it? Kevin, what do you think? If we triggered it for just one unit, how much would our deductible be?
So it depends on the type of loss, but I did find all your signature documents from the
Mhm.
renewal. And you did sign the option that's 3% subject to 100,000 minimum
Mhm.
and a statement of values. That's the same. The only thing that's odd is the numbers aren't adding up. Like that 8 million number
Mhm.
isn't shown. It shows a lower number. So you
Right.
could have just updated it after the fact. But
Okay.
everything that you signed shows 3%.
Okay.
But again, if he told you different, I mean, that's not what you signed or what he showed you.
Okay.
Which document are you looking at?
So she sent me, it was 112 pages, and it was called the renewal signature documents.
Okay, I don't have that one.
And so it starts out with a finance note, and then it goes through basically everything you signed at last year's renewal. And so it has the spreadsheet with all the different options, which she electronically signed, and it says 3%, subject to the 100,000 minimum. Looks like the premium's 92,000 for that option.
That sounds
Um,
about right. With financing, it became about $98,000.
Yeah, and then it goes into all the other signature documents that were required for every policy, and there's some more for the property, which they have you sign a statement of values, and he put the statement of values on this that was signed at 3% as well.
Fine.
So let me see if I can share my screen really quick. I've got something real short. I just wanted to
For those of you who have just joined, do not worry if you have missed the first part of it. This is being recorded. Let me double check it's being recorded. Yes, it is currently being recorded. So after the meeting, we're going to provide a link to the recording. Go on, Kevin.
Sure. Okay, can you see that?
Yes.
Yep.
Okay. Which are you seeing the declarations or?
Yep.
Okay. So I think from an agenda standpoint, and again, for those of you that just joined, my name is Kevin Kimmel with Brady Chapman Hall and Associates. Been working with your board for your upcoming insurance renewal. And I think the best place to start is one, look at your declarations, because with townhomes, they're different than condos. Condos, you have to purchase coverage on the residential units at the association level. Townhomes isn't even a true term in the state of Texas. But you have the ability as townhomes to make the individuals responsible to cover the structures, or it can be at the association level. And so where you look to that is in your declaration. So what's shown here is it basically just says the association shall be required to obtain and maintain to the extent obtainable that's key. The following insurance.
Oh, we only see the agenda, not the,
Okay,
deck.
perfect.
Yeah.
Let me pull that over.
We're seeing your Word, not the PDF.
How about that?
1 second, keep going. Not yet. Word document right now.
This is so does it say section 1, maintenance of insurance coverage?
No, it's
We
just
are on
it's just the agenda document, Woodhaven Townhomes agenda. Yep, there's your mouse.
Wonder why it's
Can you
not
just
picking up.
stop sharing and then share again?
That's interesting. Yeah, let me move it and I'll share it to a different the screen that's on. Share. Here we go. How about that?
There you go.
Okay. So this says the association shall be required to obtain and maintain to the extent obtainable the following insurance. Fire insurance with extended coverage, vandalism, and malicious mischief endorsements, insuring all building and improvements situated on the lots and the recreational and common areas, including all bathroom and kitchen fixtures, but not including furniture, furnishings, or other personal property supplied by the owners, together with all air conditioning and heating equipment and other service machinery contained therein, and covering the interests of the association. And then it goes into further saying it should be insured, including your mortgagees, in an amount equal to the full replacement value of the buildings, improvements, fixtures, and equipment covered thereby, without the deduction for depreciation. So I am not an attorney, but our interpretation of your governing documents is that they would apply as originally constructed. And I would say one of the biggest misconceptions in our industry is most individuals feel that there's what's called walls in, walls out. And so a lot of unit owners will purchase coverage for their interior, thinking the association's coverage only applies to the exterior. And so again, with you guys being a townhome association, at the time of loss, an adjuster will go to your governing documents to make a coverage determination based upon how they read. So it says you're responsible yourself for your own furniture, furnishings, and other personal property. So I think understanding what the association at this point in time is required to insure and what it's insuring is relevant.
Is this from the bylaws?
It's from your CCRs, your governing documents. So it's not the bylaws. It's a separate governing document. So why some of the details that were shared earlier by your board president, I always like to share why. And so this is just a quick visual of the 2002 weather map. And there was 18 separate billion-dollar weather events that occurred. One of which was Hurricane Ian that hit Florida late that year. That loss alone is estimated to be at over $100 billion. So as of this year, 2023, as far as September, we had already sustained in the United States $23 billion losses of at least $1 billion or more. So that's why you're seeing property premiums increase. We are seeing in the last year or two what's being deemed a market correction, where carriers are now actually analyzing losses and adjusting rates accordingly. So right now, to give you an example, and I hope this screen will share. So are you seeing a spreadsheet now?
No, just
We're
the,
still seeing the map.
That's so weird. That
No.
it doesn't bring up. Okay, I'm gonna stop sharing and then I'll reshare that. I built a separate spreadsheet, just kind of what your current coverage looks like.
We're not moving.
Share screen. Share. So this is a snapshot of what your current coverage looks like from what was provided. And it shows that we've got a $8 million limit built in 74, 81,095 square feet. So what carriers look at is your valuation. Valuation is the replacement cost per square foot. So based upon your square footage and the total insured value, you're at $99 a square foot. The majority of insurance
So
carriers.
hold on, Kevin, Joy said that they see nothing. Joyce, unmute yourself. You see nothing at all? Do you see participants? Do you see spreadsheet? Do you see, what do you see?
Are you not seeing the spreadsheet either?
I see it.
I see.
Okay. So essentially, you're at $99.32 a square foot. When we go out to market, the majority of our carriers start at an absolute minimum of $125 a square foot. If I ran a replacement cost for your community today, for as originally constructed, it would come in between 160 to 180. The challenge with replacement cost estimators is they don't factor amplification. Amplification is best described as an example using the freeze of February 21, right? I don't know if any of y'all sustained damage, but plumbing repairs weeks or months prior to that February event were significantly less. There's not supposed to be price gouging, but when we had a statewide freeze, materials and contractors all became scarce. And so the fire or a plumbing leak on a Tuesday is significantly different than a freeze that is geographically or statewide. And so that's the biggest challenge with property insurance, is trying to determine, as your governing documents call for 100% replacement cost, but it's hard to determine that because you don't really know until the time of loss, just using the amplification as an example. But where you're insured at today is significantly undervalued. However, from what the agent's putting on their certificate and what I've seen, they're showing the coverage is blanketed, which is good, and that is going away. So I'm going to go back to the agenda really
But let me
quick.
ask a question though on your square footage analysis. I mean,
Sure.
that's assuming that there's a complete total loss of all 46 units. Right. I mean, like if let's say we had a fire that burned one building down, which would impact, I don't remember how many units are in a building, four, seven, something
They
like
vary.
that.
Different.
Or 8.
7 or
But-
8, but it's okay. Let's imagine 7.
So if it's 7 units, then, and those are the ones that need to be, you know, basically taken down to the ground and rebuilt. Under the current policy, that should be fully replaced. Is that correct?
Correct. So if it truly is blanket insurance, like it says, I'll give you a quick example. So it shows you have 8 buildings and you've got $8 million in value. So just for ease of numbers, let's say each building was insured for $1 million. Okay. With blanket insurance, if one building burns to the ground and we had it insured for $1 million as an example, and it ended up costing 1.5 million to repair it. With blanket insurance, you have up to the $8 million. So you're fine. The fact that it's over doesn't matter because you have the full amount of insurance.
Right.
Obviously, less your deductible or any type of limitation.
Which is how much?
Well, it
Which
varies depending on the covered cause of loss.
I think the sheet said that the deductible would be 25,000.
25,000 for all other perils except for wind, hail, 3%, subject to 100,000 from what was provided.
Yeah, the deductible is 25,000 with the exception of equipment breakdown. It says that's a $10,000 deductible.
But
And
we're
then
discussing fire right now. So just clarify that we're discussing fire, not hail.
the
Because
fires, yeah, it's
25,000.
25,000. So if one building burned down, right, you know, the 8 million, and again, I'm just trying to talk through kind of likely scenarios, right? The likelihood of the entire 46 unit, you know, that's basically the entire street getting wiped out. So,
I would say the only plausible scenario under which the entire 46 units would be destroyed is a tornado.
Yep, and I've seen that very close to y'all.
Correct, but
Um,
also the likely scenario would be that if we get hit by hail or wind, then equally all 46 units would have similar, well, very similar types of damage, wind and hail on all 46 units on.
Yeah, I mean, I think where I was going is, I mean, I don't disagree with Kevin on just, making sure you're appropriately insured and replacement costs have gone up, but I also want to make sure we're balancing that with the fact that I don't want to over insure either and drive costs up to where, the likelihood of us replacing the entire community is almost zero. So,
and let me just finish really quick because that's exactly where I'm going with this next. So the other property form, which 75% of the carriers have reverted to, is scheduled per building. So what they're going to do is make you assign a specific value versus giving you the $8 million blanket. And majority of carriers have gone that route, but blanket coverage is still available in the superior coverage form. So the same example, if we had 8 buildings and each one was insured for $1 million and you had a $1.5 million loss, what's scheduled per building, if we had it at $1 million, now we're short 500,000. So where valuation becomes even more concerning is when you're dealing with non-blanket coverage where it's scheduled per building. So what we would do is go out to market as your agent if you want to continue insuring the coverage at the association level with a couple different options. Blanket, again, the new minimum to get blanket options is 125. However, there's still 75% of the market out there that we want to approach. What we would start at strategically is $150 a square foot, come back with a price, and then look at all the options we have on the table. So we're literally running multiple spreadsheets where we'll show a one-liner like the spreadsheet I showed you before, where it just has one line across 8 buildings, here's our value, versus all the carriers that offer scheduled per building require you to break down a value for each one. So we'll start at 150, see where pricing comes in at, and then have a discussion with the board. Hey, 150 is probably too light if this is our best option. So if we wanted to go to 160, 170, 180 a square foot, here's what it would look like based upon the property rate. And here's our blanket options to consider. Which route is best? And of course, if premiums are close, blanket is always the better option for you to do. But
I
that's
guess I
our
don't-
strategic
but-
marketing approach.
But I guess I don't understand why would we go for a higher dollar amount per square foot if if it's a blanket coverage and the likelihood of there being, a massive loss is extremely low. Because I mean that's what, almost a 50% increase in cost per square foot, right?
So these are the new minimums. So when you go out to market, nobody's going to offer you coverage at $99 a square foot.
And when did those go into effect?
So your current carrier that doesn't even offer blanket coverage anymore, it's going to revert to schedule per building at the renewal.
Okay.
So that's where I was saying we're going to have to go out to market. We're going to start at the absolute minimum for all the carriers, which the blanket carriers that we're going to approach for you is 125. And then the schedule per building carriers is 150. We want to start lower on the schedule per building option because it would raise red flags if we started at $200 a square foot and then say, okay, we don't like the pricing, let's go to 150. The carriers will say, well, we want to see a replacement cost appraisal. So we're starting on the low end because, like I said, if I ran a replacement cost estimator on your building today to replace it as originally constructed without factoring amplification, it's going to come in at 160, 170, 180. So we just start there. The goal is going to not to go with a blanket not to go with a schedule per building option and go with a blanket option. But I can tell you there's also some scenarios where I haven't seen your loss history. So depending on how that looks, the blanket option could be double what a schedule per building option came in at. So we're just running all the types of scenarios. So at the end of the day, you can make an educated decision once we get everything put together.
When do you have the loss runs from the previous carrier?
I'm waiting. Eric said that he's on a wedding vacation, but I know that we did not have a single loss except for one personal injury in 2019. So that personal injury was the only law that we filed for the last 5 to 10 years.
Okay, and that should be general liability, so it wouldn't even be a factor in your higher.
Correct.
premium
It was
policy.
a slip and fall, yes.
Yeah,
Okay.
I
So
mean,
again, I
that,
think we've gone through, declarations today, how your coverage currently apprised. We talked a little bit about state of the market, and I'm going to share some more visuals with the board, as well as some articles on this market correction that we've talked about, how we would approach it. We've talked blanket first schedule per building, which is significant. And now I think the last piece is obviously, again, as unit owners and as the board, you have the ability, and you'll have to talk with your attorney to change your governing documents to make unit owners responsible to ensure the structures versus the association as it's reads and is done today. And so there's some pros and cons to that I think everybody just needs to consider. And so that's kind of what this goes into, is you lose a lot of control versus having
Before you go into it, can I finish presenting the HOA part? So we have not started on the individual insurance yet. So can you just hang in and let me finish presenting the slide that I prepared so we can kind of
Yes,
transition into that one.
I am sorry, go ahead.
Yeah, let me do that. So right now I updated the numbers as you were talking. So before I had 5% deductible, now I have 3% deductible. So now the slide should reflect what you guys are discussing. So I still need to understand if we're on 5 or on 3 and where the 5 came from Eric. But let's just assume that 3% deductible apply. So in that case, just to run down again, our down payment of $31,000 was last year. Our monthly payment last year was $6,300. On average, from approximately 2020 and to now, I'm seeing an average cost per year increase anywhere between $9,000 and $17,000. So I'm taking $11,000 to $12,000 at an average increase of cost of insurance per year. So if, for example, our current insurance cost is about $97 with financing fees included, then if we increase it by, let's just say $11,000 or $12,000, that means that our cost of insurance is going to be approximately, $110,000 next year. If we're lucky, if nothing else goes up. And then our monthly premium is going to increase, let's just say, to $6,500 or so. So as of right now, we were not able to purchase the wind and hail buyback this year, which means that let's just say that we have I don't know about buildings burning down, but most likely thing that happens to us typically the roof, right? A roof leak. So let's just say we have 5 units leaking at the same time. What we're struggling with is that right now we have no ability to file a claim on those 5 leaks, even if those leaks are caused by a lifted shingle from the wind. Why? Because if let's just say I have a unit that has lifted shingles and it caused a leak, then for me to trigger the deductible, what would happen then, Kevin?
To trigger the deductible
Or to
for wind and hail?
to trigger the insurance. Let's just say filing a claim for 1 leak. What would happen?
So if it's a loss from wind or hail, it is 3% of the total insured value. So that 3% of that 8 million number.
So that would be approximately $240,000, right? So which means that if I have a roof leaking and the total cost of repair of that roof is, let's just say, very hypothetically, $3,000. For me to claim an insurance, to put an insurance claim on that specific leak is going to cost us $240,000 in deductible before we can start the $3,000 repair. That makes sense? So it makes no sense to trigger an insurance when we actually have an insured cost leak. So my problem is that, and with no wind and hail buyback, if, for example, tomorrow we have a wind and hail event that is strong enough that, let's just say, not just 10 shingles are lifted, but let's just say roofs are completely bare, everything is under our units is littered with shingles. And now we have to call the insurance. Our insurance is going to say, Kevin, explain again. It's going to say your roofs or total replacement is, let's just say 500, right? Minus depreciation, whatever it is. Let's just say we can offer you $410, at which us as homeowners have to come up with $240,000 before we can complete or even start the work. So here is my problem. We have currently Hill or Sam, correct me if I'm wrong, don't we have like 4 units or 5 units leaking at the same time? So I cannot file a claim on them. And because I cannot file a claim on them, not only are we paying $6,300 per month, so our total income from all units is, let's just say $11,000. So out of $11,000, take $6,300 at the beginning of each month, and that's what's left for everything else, for roof leaks, for maintenance of the grounds, for trees being cut, for falling carports, for everything. So by giving the $6,300 away, I'm basically left with about what, let's just say $5,000 left in my budget. If we have 3 units leaking, each one of them costing, let's just say $3,000, $4,000, that goes my entire bank account. And it's only to repair the roof. I haven't even started with the repair of the interior after the leak.
So
Make sense?
Kevin, real quick question, not on the total coverage, but if it's by building, then the deductible is just by building, correct?
You would think most carriers are still doing it based on the total insured value and not per building.
That's what Eric told us. He said that the way that it's currently written, it's total insured value.
Yeah, no, I know the way it's currently valued, but right now we're covered. I forget what you called it, but you know, it's
Blanket.
blanket, yeah. But if it goes to a building, then
They still do it on the total insured value and not the value assigned. Years
Is
ago, they did it on value assigned. This market correction, they switched it to total insured value, just like blanket.
Okay, so it would still apply across everything. Okay.
So let me
Even if
switch.
would,
Go ahead,
even if
Joyce.
you're just insuring the building, each building separately, that doesn't sound fair.
No, well, there's a policy type where you can break it. It's the coverage is down. It's by building versus blanket. So.
Yep.
Well,
Just
whether it's fair or not is a different question. We're talking about what we currently have.
Right.
So I'm looking at the next year. So guys, the reason that I called you today is because as a board, the board needs now to decide what we're going to do, because we basically are in a what I would call strategic dead end. We're at a strategic dead end, because when you have 6 units leaking, and when you have 3 or 4 wind and hail events happening side by side, with roofers telling us you have hail damage, you have wind damage, please file a claim, you're going to start leaking soon due to this lifting shingles. What am I going to do with that? I know that we can file a claim potentially, but do we have $240,000 to start with? And will, even minus depreciation, will we even be able to pay for the full replacement of the roofs? So that's my problem. So at this moment, for all intended purposes, we are entirely self-insured. We're paying $6,300 to some unknown person for them to say, sorry, can't help you in case you have something happen. So basically, let me finish, Michael.
Yeah.
Not only are we self-insured, but also we have an extra tax that we're paying $6,300 per month currently that we could have used for repairs, but we cannot use them because they've been paid to insurance. Go ahead, Michael, now.
No, I was going to say, so I think I get the point, or at least to me, Elena, it's clear the conundrum of, you know, with the deductible, whether it's 240 or 450 at this point, I don't know if it matters. So I guess I'm curious at looking at the you know, the sheet that Kevin had on kind of what's the alternative,
let's go-
which is the
if-
single policies and kind of what's the pros and cons of
Be-
that.
Before we go into that, Michael, Kevin, can you go ahead and talk about HOA? Can you see my screen, Kevin?
Yes.
Can you talk about these two issues too, on top of that?
Yeah. So if you're not currently purchasing a policy, you should be, and it's typically called an HO6 or an HOCOM, COM type policy. And it essentially dovetails with the association's policy, but for you. So again, the declaration stated you were required to purchase your own contents coverage. You also would want some of your own liability coverage in case somebody slipped and fall. So the HO6 is going to encompass general liability coverage for you. You also have some property coverage. And so what you can do is purchase building coverage so that in the event a loss occurs that is underneath the association's deductible, you can try and turn to your personal lines coverage and be assessed only that deductible.
Okay, so Kevin, let's just stop for a second here because all of this is really good and I already ran my numbers, so that makes sense to me, but they probably do not have the good understanding of that. So let's just take an example, right? Let's just say that we have wind and hail event and we decided that we cannot just patch it up. It's impossible. We have to turn in a claim, right? So let's just say that we turn in a claim and let's just say that the roofers comes through and they say your total cost of total replacement of the roof, the gutters and everything is $500,000 or whatever it is. And let's just say that the insurance says, well, you also have depreciation, so we can only issue you, just say 400, right? Just say 400. Out of which what was my number here? Out of
240,
which
so 160.
240, let's just say 250 for easier counting. 250 is what we're supposed to bring to the table. So we're left with, let's just say $150,000 that insurance is actually paying. Okay, so now imagine that we have this HOA loss assessment policy. How would that work?
So the way loss assessments, unless there's a specific limitation within the personal lines policy, if there's a covered cause of loss at the association level and you don't have the funds to pay it and the board determines to do a loss assessment. So let's just say it's that 240,000 number. And let's just say when you get with the attorney, they allow you to do it evenly amongst the units. It could be square footage, ownership share. I'm just for ease of numbers, 240 divided by your 64 units.
60,
Is that right?
46.
Or 46 units?
46.
Let
Yeah,
me punch it in. So,
Clubhouse 47.
well, Clubhouse, nobody owns it, but that's okay. So it would be, let's just say 240, just because it's precise.
Divided by the 46. So
By
you're looking
46.
at $5,218 a unit.
Yes.
So if you purchase loss assessment coverage, and you can look to turn it in there to your personal lines agent. What we're being told, and I'm not in personal lines whatsoever, I only BCH only offers commercial coverage. But what we're told it is to go and get loss assessment coverage for $50,000 or $100,000 is $20 to $30 annually. Versus one of the deductible buyback options you guys received last year in itself to get it down to 25,000 was $46,000. So instead of doing a wind hail deductible buyback at $46,000, which would essentially cost everybody $1,000 a piece, you can look at it differently. Go to your HO6 in personal lines insurance carrier, buy loss assessment, buy 50 or 100,000 for 10 or 20 bucks. And it's a more cost-effective solution.
Each unit, not us would do it. Not insurance would do it. Each individual owner would add the loss assessment policy to their.
Yeah, but how do you get each individual owner to do that?
Well, that's a different story, but we're assuming that an ideal scenario happened and we do have that on each unit. Go ahead, Kevin.
Yeah, so if everybody doesn't do it, then they have to pay. And again, all depending on your governing documents while working with your attorney, if they don't have the special assessment coverage or loss assessment coverage to turn in to their personal lines carrier, then you have to pay the $5,218, where you may be able to turn it in with little to no deductible. The one thing I would add is we have seen in some scenarios some of the cheaper personal lines policies, well, will limit the loss assessment coverage to $1,000 or $2,500 if it is for deductible purposes for the association's policy. So again, what we always recommend is take your governing documents, the CCRs we read through earlier, take your current certificate of insurance that was up. And then I also have a frequently asked questions document that I'm going to share with the board. It's a 2-page document. The first page goes into what's typically covered at the association level. The second page goes into options and coverage forms you should consider with your personal lines agent. So loss assessment is one of them that's recommended in there. Loss of use is another one that's in there that's recommended. So what loss of use is if your if your building burns to the ground and you need to go live elsewhere, loss of use is the money that's provided in order for you to live elsewhere until your unit is rebuilt and you can move back in. So
if we
Would you
decided that we,
send that information to everybody that attended this meeting?
yes, and in fact, I'm going to share the slides with everybody, not just anybody, not just people who attend the meeting. And also we're recording this conversation, so everybody's going to get a link to the full recording and the slides. But so hypothetically, if we were to stay with the HOA carrying the insurance, then these two policies, if assuming in an ideal world scenario, everybody add them to their HO6, could help us to alleviate some of the problem that we're experiencing. That correct?
yep.
Okay. It
It's
would
done
still
correctly,
be
yes.
quite a process, right? So if I understand correctly, let's just say that we do file a claim and the insurance says, go ahead and replace the roof or approve it. We would then pass a special assessment called loss assessment, correct? That would still require 80% or 70% of owners to pass that special assessment. But let's just say it's passed. Then we would say we have no way of collecting it. Then we send the bill to every unit, and then each unit have a certain amount of time to bring money into the, into some kind of a pot, whatever, like maybe our lawyer holds some kind of a account, escrow account where the money are covered, money are held. And then once everybody pitch in, then we're able to get started on actually doing the deductible, correct, Kevin?
I'm not sure about the attorney piece, but again, essentially, if the carrier will send you depreciation amount less any limitation and deductible to get started.
Gotcha. Okay.
Kevin and Elena, this is Glenda. Aren't we a little bit ahead of ourselves in that Kevin keeps mentioning that we have to find out what our current documents say? Don't we need to first find out what the association is responsible for?
You joined a little bit late, Joyce or Glenda. We did review it at the very first part of the meeting.
You did what?
Kevin, do you want to share it again?
Well, I've just heard him say that we need to get with an attorney to determine what the HOA is responsible
Agreed.
for.
The fact is that you kind of joined maybe like 15 minutes into our conversation, and the first thing that we did in the first few minutes was to review those documents. So we do have the documents, and maybe Kevin will share. Oh, Kevin, you cannot share because I'm sharing. Stop share. Feel free to share, Kevin.
Yep, I'm just pulling it back up. I had closed it. Give me just a second. Okay, here we go. Screen. Okay.
So it is in our articles of incorporation, Glenda. You should have a copy. It's not bylaws, it's articles of incorporation.
No, this is your covenants and
Covenants and
restrictions.
restrictions, I'm sorry.
Yep,
So,
your CCRs.
if you want to, Glenda, Joyce, ask me for a copy of covenants and restrictions, but take a picture of this Article 3 so you can then look up the Article 3, which talks about the required coverage.
Yeah, Article.
Oh, I'm so sorry, not 3, Article 8. My bad.
Yeah.
My bad.
Okay. And or page 20 of 33 of the PDF is if she's sending you the same exact ones. So this says, with respects to insurance, the association shall be required to obtain and maintain, to the extent obtainable, the following insurance coverages: Fire insurance with extended coverage, vandalism, and malicious mischief endorsements, include insuring all buildings and improvements situated on the lots and the
So
recreation.
can I stop you for a second, Kevin?
Sure.
It says fire insurance, vandalism and malicious mischief, insuring all buildings. It doesn't say wind and hail, does it?
It does not,
Okay,
but
so basically it said that fire we have to, but wind and hail, because we do have two different perils, right? We have wind and hail, and then what you call everything else, right?
exactly, all other
And
perils.
everything else is $25,000 deductible, and wind and hail is the only difficult child.
3% of the total insured value today. From
So
what
is that
we've shown.
possible for us to split our insurance somehow? So let's just say the insurance by HOA does contain fire and vandalism and malicious mischief, whatever is spelled here, but it does not cover roofs or wind and hail, because roofs are not covered, specifically wind and hail is not required in this particular declaration.
I have a question.
Yes.
Well, one point and then a question. One point is this was written in 1974 and
Yes.
the landscape of insurance and everything else has changed
That's
considerably.
true.
My question is, do these still stand, or do I recall when we were going through it some years ago that there were some alterations to this through
Yes.
amendments?
So I will need to pull together the Texas property code. Do you know just offhand, Kevin? Because I remember in Texas property code, there was a provision for an insurance coverage by the HOA, but it was more or less to make them to maintain some kind of a minimum. So I do not have that in front of me right now, but I thank you for asking that question. I can take down that question and then look up the Texas property code.
So depends on what code you're looking up. So again, if you're considered a townhome, which again isn't a legal term in Texas, then you're not subject to 82.111 of the Texas Property Code, which is condominiums, which there's documents there that supersede documents from 77 or anything prior to 94. So I think that's what you're referring to, but townhomes fall under single family, which is property code 209, and there is nothing that would supersede your documents. So you would have to look there or to any amendments that have been done. And I don't know if there has been.
That's what I
that
was.
wasn't shared with me.
Actually, our lawyer already reviewed it, and they said that it is, even though we're not condominiums because we're located in a county with 2.5 million population or more, we still like it has a differentiation. If we were located somewhere in Grayson County, it would be different than if we're located in Dallas County. At least that's what
News to
she
me.
highlighted for us. That
That doesn't make sense.
Yeah. But again, that's where we always say, we're not attorneys. I'll give you our interpretation based upon reading these governing documents from other documents we've seen, what we know from working in conjunction with attorneys, as well as what we've seen from claims being paid on condos versus townhomes. So to us, condos are subject to the Texas Uniform Condominium Act. So you're required to insure the units at the association level. You can't change it to make unit owners responsible. And you at least have to insure it to original construction. Unless the documents read broader, then you can. So you could say, let's include improvements and betterments or things of that nature that are further more than originally constructed.
Oh, I see.
Townhomes,
So,
you have to look at the governing documents and how they read, because they could read, you're required to insure based upon what the association's required to maintain. And then there could read that the individual's required to insure what they maintain. That could read 4 million different ways, depending on when they were written. They could be written where the unit owner's responsible. They could be written where the association's responsible, like this. So it all depends on how they're written when it comes to townhomes.
but my original question is, so just say we are mandated by this document to maintain fire, malicious mischief, and vandalism. Is it possible for our policy, the HOA policy, not to cover wind and hail?
Yes, there's carriers that will offer all other perils coverage.
But not,
I would decline and back
Good.
away and not
Right.
offer that, because that's just asking for us to be sued when
All right,
everybody's would interpret and expect for that coverage to be there.
gotcha.
Well,
But if you
I
change
have
your
to
governing
say-
documents and which took a certain number of vote, and that's how you wanted to go, then I would feel comfortable with it. But I wouldn't suggest doing that. I would only suggest either leaving them as is, maybe changing them with some wording to make unit owners responsible for improvements and betterments. Because that doesn't seem to be outlined, so I think that could be a little clearer. Why should the association have to be charged in the board with figuring out what improvements and betterments have been done and how they have to factor that? And then if I lived in one of the units and I've completely upgraded to marble, why is everybody else sharing in that cost when you can buy improvements and betterments coverage with your personal lines agent for anything that has been done from original construction? So that's typically what we would recommend for townhomes is either insured at the association level as originally constructed, and or make unit owners responsible if you are comfortable with that type of situation.
may I ask a question? Would it be cheaper for us at the association level to buy 47 policies and pay for it at the association level versus putting them all together?
Is it
No,
possible to buy 46 individual policies by the HOA? I don't think so, because it's just one.
I
one-
know that Serena and Ahill, I think both have said that they can get insurance on their townhouse cheaper.
But not at the association level, at an individual level, but not at the association
I
level.
think maybe what she's saying, Joyce, if I'm misinterpreting, but I think, are you saying have the association pay for the individual policies?
Yes, but make
Association-
47 different policies versus trying to lump sum it.
We're not
cheaper.
owners of that policy. Correct me if I'm wrong, and I know you're not the
personal lines agent.
yes, you're not that kind of agent, but like if I wanted to insure Joyce's property, can I?
No.
Well,
That's a great question, a
I
great
think-
Well,
idea.
you are now.
What you would essentially have to do is make unit owners responsible, and then instead of paying into a fund in your assessments monthly to pay for insurance expenses, you work with your attorney, you change your declarations, and you just go out and buy insurance on your own.
Okay, that
That
brings
wouldn't work because you may have 4 different insurance companies with one building and they're don't agree on who's responsible.
That's
You know,
part of
that's
the
all-
pros and
that's
cons.
that's a different,
Yes.
that's a different, so every solution that we have will have some obstacle. There is absolutely no solution that we currently have, either it's HOA coverage or individual coverage. There is none of them that will say, oh yeah, perfect choice, no problems whatsoever, let's do it, 100% behind it.
But I don't understand you're saying that we would have to do it individually, because right now the association is paying for the insurance, but they're just lump summing it all together versus doing multi policies.
No, we have commercial insurance right now. You would have an individual insurance.
Yeah,
Well,
I
maybe
guess,
it'd be
but again,
cheaper
I
to
think,
have residential insurance.
I think what the way to structure this, we probably have to ask the attorney is the association still collects the dues and then uses that money to buy or to, sort of designates that money per unit to buy an individual policy. It's a way to enforce that everybody has it. Like you can put it in the CCNRs that everybody's got to have, is required to have, or bylaws, whatever, everybody's required to have an individual policy. But if they don't, and then there's a loss, then there's a problem. So it'd be interesting to see if an attorney would say, yeah, the association can collect those, and then those funds can only be designated for individual policies, to purchase an individual policy.
Okay, for us to kind of look, since we started to talk about individual units, can we present the findings about individual unit that we collected? Before we proceed into discussing who obtains, who collects, who what? Can we start by looking at the actual cost of individual coverage for a second? So
I
my,
don't understand why we're having to buy commercial insurance for residential property.
because it's a very large multifamily dwelling. But anyhow, just because you don't understand it doesn't mean that it's incorrect. Anyhow, let's look at the potential individual units coverage. So we have, or not we, let me not take the credit. My husband has done quite a bit of research on the cost of individual policies. Let me stop sharing now so I can share something else. Give me 1 second. Oops. So hold on, where is this? Okay, can everybody see the file that says summary cutouts?
Nope.
You
No.
cannot?
Nothing yet.
Oh,
Okay, stop sharing. How about now?
There you go.
Okay, honey, can you go ahead and kind of walk through what you got so far as quotes?
Well, I reached out to about 5 or so agencies, and I only got a response from 2 worth presenting. That's the top 2. Now, the one on the bottom, I put it in there anyway, and it really doesn't apply, but it's almost identical, so it's a moot point. Just so you know, I say it doesn't apply because USAA only insures active
Military.
and past military people. So the top 2, Allstate and State Farm, came back to me, and they gave very similar quotes. So this is, and they said they do this quite frequently because the blanket coverage is becoming so expensive. So they're breaking it out so that the individual members of a townhouse association can insure their structure and roof and everything. And that's what this is showing. It's a little small here on the screen, but basically total coverage costs is what you would pay per year. And the way it breaks down is 217 to 280 something per month, which would be essentially, I would assume, would be
about half of what we're paying now.
well, it would reduce, yeah, it would come out of the dues. Now, the overall insurance costs, blanket insurance costs for certain things, I'm assuming, would still have to stay there. But if we have these individual ones, it would certainly offload a lot from that, and it would allow people to handle it on an individual basis. So your whole dwelling protection would be, now these are numbers that the agent sent me. One covered it at 245,300 roughly, and the other was 303,000. But that would be for you to fix or replace the individual unit, walls, roof, everything, if there was a fire, for example. Then you have liability coverage, medical, personal property, and this spreadsheet goes on off. This is just actually a little window I cut out of it, so it goes on twice this width at least for all the things involved. But the basic things I was looking at were the dwelling protection and the personal property and things like that, and liability, and they're all matching up pretty close. So just all this was to do was try to say, do you insure individual townhouse units to these insurance places? And they said, yes, we're seeing more and more of that because the blanket insurance is going up so high. So we would have to figure out how, if we wanted to go this route, it would potentially cut it down, but it just seems like too simple a solution. So I'm wondering what else is going on here and what we still have to maintain as far as consistency across all of the units, because we can't have one unit insured for $500,000 and the next unit next to it insured for $200,000. It has to be some minimum level, and that's probably, if we're going to go this route, when we change the covenants or the bylaws or whatever we have to change, we would have to, state a minimum, amount of coverage probably for each unit, just to ensure, or that's a bad term, just to make certain that we all, are maintaining adequate insurance, for replacement value.
Okay, hey, honey, hold on just 1 second. Kevin.
I'm finished. That was it.
Okay, Kevin, just looking at this coverage per, it says dwelling protection. I'm not sure what dwelling protection, how it's different from any other protection, but let's just say dwelling protection means property insurance, right?
It's the building.
At the
That's
building.
what that is.
So in your opinion, would that be enough for the replacement, what they're offering?
What's the square footage of your unit? Do you know?
18, let's just say 1864. That was our unit that we took as asking them to calculate.
1864, including or you guys have, so that's $131 a square foot. I would say that first option is very light.
Okay.
If I go with 303, 123 divided by, what was it, 1865?
1864.
1864. That's $162 a square foot. I think that's a lot closer. I think you could end up having losses that end up costing more than that. So I think what you're talking about here is that would be one of my concerns is, and your husband alluded to that, is trying to do something to make sure the community insures it to a certain number.
Let's just say per square foot, right? So no less than 1x per square foot, like 130 or 150.
Yeah, and then what I would do if you're going to go that route is write in the declarations the ability to do an annual resolution of that minimum so that you can change it and don't have at the board level, and you don't have to go and get 75% every year.
Gotcha.
So this way,
we need to
if we
keep up.
see inflation, et cetera, and we know it's going to be more, you just end up doing a resolution, which is the board signing it versus an amendment and going and getting all the votes that are required based upon the documents. And you can increase it from 160 to 170 a square foot or whatever the board deems is necessary year to year.
Gotcha. And then question to you, I see that there is roof structures, extended coverage. Do you have any clue what that could mean?
So the family limit of liability, that's going to be like your general liability, slip and falls, or if somebody was bitten by a dog, if you owned. The guest medical, that's gone away in the commercial side for the most part. That's typically, hey, if somebody was injured, I'll pay your doctor bill and hopefully they won't sue you. A lot of times it's led to suits. Personal property is going to be your contents coverage. So that's all your tables, your furniture, your clothes. Other structures, carport or fence, that would be obviously any fence you're responsible for based upon the declarations. And I did see you guys had carports. Living expenses, I would think is gonna, I don't know, because it says, max 24 months. That's pretty much like loss of use.
Yeah, I
For
think
you to go live elsewhere.
another one. I think they're calling State Farm calls it loss of use, and maybe the other one would call it.
Yeah, it's difference of terminology between the two insurance agencies.
Yeah.
Yeah,
So I mean, and then the roof structures extended coverage, I don't know what that would be.
I would probably need to clarify. And then it says, seems to like Allstate also has wind and hail, 1.5% deductible, it would look like.
Yeah, most personal lines are 2%. Some are still offering 1%. I pay a higher premium for 1% personally.
But this is just guys, we're kind of chit-chatting back and forth about what could, potentially could be a better quote among the two or the three. But overall, the takeaway is that anywhere between 217, which Kevin considers a little bit too light in terms of their coverage, to 283 per month. Let's just say if units carried it in an ideal world, all units carried it, and then potentially we could have a coverage where individual units cover their building and their roof, which means that we can then change our bylaws for the HOA no longer to be, maintaining the walls, maintaining the brick, maintaining the fences, which mean that our HOA dues would of course, drop because of that. Let me go ahead and continue to share this pros and cons, and then we'll switch back to your last few points, Kevin, because I want to finish up that presentation that I prepared. So hold on just one second, and then
I'm gonna
we'll
grab a
switch-
water. I'll be right back.
Yep.
I just wanted to interject while you're doing that, those numbers
Yep.
that they gave. I think those are, again, like he said, a bit light. They're looking at trying to get new business, and I think they were quoting their best case. I think once we look at it and once we figure out what needs to be covered, and they realize what they're responsible for, et cetera, I think those numbers would go up a bit.
Hey, Elena, I have to drop. I have to go get my kids to bed.
So do you have any other questions to Kevin before I drop?
No, Kevin, I appreciate the help. I think I think the challenge is clear. So Elaine, I think, kind of three options are standing out in my mind, and I'll let you guys continue, but I think
Right.
one, I think we should just see what the renewal costs look like from the commercial
And
policy.
also, Kevin, do you think that we can get 3% renewable deductible, or do you think it's going to go up?
I do think 3 is still available.
There's
Two,
still-
I
three,
think
and
we should
you can look
see-
at options going to 5 with the loss assessment and see how that looks, what that looks like.
Yeah, I think the options are see what the commercial policy renewals, what the the best option is, and then how does that HO6 thing factor in? Is that an option for us? Then I think the last option is the
The
move
individual.
to individual policies, but how do we secure and enforce that?
Yep.
And
It's
that
a
would
little
be the
bit of
challenge.
a can of worms.
It is
Yeah,
a can of worms. So basically, at this point, what my slide said that we can maintain continuous. So
thanks, Mike.
The
Yep. Thanks, guys.
upside to individual coverage is that right now, if, for example, 611 or 513 or 546 unit leaks, I can claim, I cannot even file, even in the best case scenario with $247 deductible, I cannot file a claim for that roof, which means that I, after paying $6,300 per month, now have to find money not only for the exterior repairs, but also for the interior repairs, which could be another 5 to 10K. So after paying $6,300 per month of the insurance that I cannot use to file a claim on an individual leak, I'm still owning that unit 8K, which I do not have. And right now we have units that have been without proper repairs inside for some of them for over 4 years, some of them for just a couple of months, but all of them are asking when we're going to get our interior repaired. So my problem is that if I cannot trigger, so let's just say that I have 5 units that are leaking, and every time the roofer goes in the roof, he said, oh, and you have listed shingles, I also need to replace a few shingles here just to keep you from out of trouble. On top of that, if I was able to replace the roof, that would solve my problems. Then I'm not doing what that game is called. I forgot the name of it. When you slam your hammer like on
Whack-a-mole.
Instead of playing whack-a-mole, a very expensive whack-a-mole, then I just say, hey, everybody, trigger your insurance. Let's replace the damn thing, because right now so I worked at Ericsson. At Ericsson, we were taught a very important principle. It was called diminishing rate of return. So when our roofs were younger, when our roofs were 4, 5, or 6 years old, we only had 1 to 2 to 3 leaks per year. Now it seems like every single meeting that we're meeting, we spend 80% of our HOA board time discussing what other roofs are leaking, how many shingles are missing, what else we found, and then the other 20% trying to figure out where to find money for it. So the problem is that the more our roof ages, and our roof was placed in 2022, so currently our roof is 11 years old. It will be 12 years old next year, and 13 years old the year after that. We cannot stop that aging process. The only way, and I'm sorry, what was the term of depreciation, or what was it, Kevin, on the roof, would become worse with every year.
Correct. Yeah, the
Elena-
depreciation factor would increase each year.
So each year it would cost me more to cover this roof. My payoff in case of a claim would reduce, and the number of units leaked would increase. So my diminishing rate of return is coming at me with a bullet speed train speed. I am at the point where I say, should we just should we continue to wag these malls at a very expensive cost of not being able to do simple repairs elsewhere if our carport is falling? Or should we just go ahead and bite the bullet and trigger the insurance to replace the whole roof and start from the beginning? That's my problem. Go ahead, Joyce.
Elena, it seems to me that, excuse me, we can't, we've got a problem with the homeowners association's repairs, the income and all that. And we can't really, you can't look to renewing insurance to solve what's gone on for 5 or 6 years, in that we don't have money. And we can't equate getting our insurance where it should be and resolving our income problem at the same time. I mean, the insurance needs to be, we need to get the very best we can at the very least amount, and it be paid for in the most economical way for everybody. But you are in interjecting the repairs, and that the repairs that we have currently that have been going on, that have been needed to be done for 2 years or more, should not factor into how we get our next insurance coverage.
So to me, it does factor in, because for me to make those repairs happen, so you see, there is 2 types of expenses in our HOA. A predictable expense. For example, I know that if our greenscape mows our lawns 3 times, I'm going to pay $1,600. If they mow 4 times, we're going to pay $2,200. This is a predictable expense which I can manage. I can tell greenscape, do not mow 4 times, mow 3 times. That allows me to minimize my expenses if I need to, right?
Elena, that does not solve our problem. It continues to be a problem.
Correct, but let me finish. Let me finish, Joyce.
Something about the income for the association, as well as get the very best renewal insurance.
But the income, it doesn't matter. What matters is expense, because you can make $1 million, but if you're spending $1.5 million, then you're still under the water. So the expenses is what needs to be controlled. Income, we can more or less decide, like, let's just say by the board meets and say our HOA dues should be this X. Boom, done. Both happened. We cannot tell the wind and hail, hey, wind and hail, strike only over there, don't strike over here. So what I'm saying is that there's 2 types of expenses: a predictable expense, which I can schedule, and let's just say tree trimming or greenscape. I can tell them I want to spend no more than $1,600 this month and do not do anything else. And then there's unpredictable expense. An unpredictable expense is the homeowner calling me and saying, hey, my ceiling just collapsed. What are you guys going to do about it? That's an unpredictable expense, which I cannot control at this point. So my job right now is to say,
what does that have to do with insurance?
What it has to do with insurance? It has everything to do
Because
with
we have had this discussion at numerous meetings, and we decided that we cannot, the insurance that we're buying is not going to cover anything, but we have to have it because our bank notes require it.
up until certain point. So up until certain point, there was a usefulness to that insurance. And that usefulness was determined by me saying, if we have a total roof loss, let's just say wind and hail situation, then with the wind and hail deductible being $25,000, I could see how having a total, coverage of 46 units with only $25,000 deductible, I could see how that could be useful. The moment that we lost wind and hail buyback and switched to 1, 2, 3, 5, 10% deductible, that calculation went out of the window. So my argument for the to say that let's continue to maintain it no matter what the cost was up until last year. Last year, once I realized that we can kiss our wind and hail deductible goodbye, then I realized that the paradigm has shifted.
Well, insurance is not going to cover maintenance.
We're not asking to cover
Correct.
maintenance. Right now, I'm talking about the leak that happened because the shingles have been lifted. So to me,
Elena,
main-
I thought this meeting was called to decide about, because we have decided that the insurance that we have is not very good, maybe. And you've had these men.
numbers, correct.
I guess Mike is also an insurance person. They've come to do, but it is not their responsibility to try to do something to make our maintenance issue go away.
So there is
There-
difference between maintenance, maintenance for maintenance for carports and an event that happens outside my control. But Kevin is at 8:34 and he's doing a lot of us for free. So let's see if Kevin can present his last slide, because we can argue about the outcome without Kevin necessarily sacrificing his family time. So let's postpone it. It's all good questions, Joyce. I just want to make sure that Kevin gets some sleep tonight before.
Thank you.
One second.
I think you're both right? I think this is great. There should be not arguments, but discussions on both ends. Some things Joyce mentioned, she's 100% right. So carriers do expect you to have a roof inspection done annually at an absolute minimum. And they expect you at that time when you do that, to be making sure the roof is sealed properly, to make sure any shingles that are missing are fixed. Because if a loss occurs from water damage because of maintenance, they will deny the claim. So you definitely want to have some documentation to be able to go back and say, hey, we've regularly maintained our roofs, and this is because of a covered cause of loss from wind, hail, fire, whatever the case may be. So I think you're really both talking about some of the same things. I'm going to really quick just go through some pros and cons.
Go ahead and start sharing again, that last slide.
You've cut us off.
now.
Okay. So the pros and cons, control is one piece, right? Right now, the board has the ability to make a decision. If you change that to individual unit owners, how do you keep track of it? Do you maintain proof of coverage? And again, remember, you're section 209, which I am as well as single family. I don't provide my HOA any documentation, but I have my own residence. I don't have multiple units stacked to one another with shared walls. So I would say that's definitely going to be a little out of the norm to keep track of it if you're not going to insure it for single family, because that's not done traditionally. Kind of like on the examples given, which were great on the spreadsheet. How do you know if it's good? And then how do you know if they've got the right amounts? Is there enough funds to rebuild? What if it's canceled? What if somebody pays their unit off where insurance is no longer a requirement, so they cancel it? Unbeknownst to you, after you, even if you collect a certificate, they can cancel it and you could never find out. One of the things I believe Joyce mentioned as well, right, with your policy now, you'd have one license adjustable versus possibly up to 46 different adjusters, depending on, and then do all the adjusters agree? How does it work if they don't? What if they're presenting different roofing materials? How do you coordinate all of that? You obviously then have the adequate limits or no insurance that we've talked about, which can diminish the value of the community, especially when you've got multiple units together. And I would say that personal lines is catching up. And I think that's what was shown in the spreadsheet. Those were two great examples of carriers that regularly people would go to for personal lines. I have mine with Travelers, but I know a lot of people use State Farm and Farmers and those that were shown. And so I think when you look right now, each unit, it's costing $2,000, to where the options on the table that were presented in that spreadsheet, just as an example, were $3,500 for one that would be closer. So it is going to cost $1,500 more in that case. I don't know what your HO6 costs.
Kevin? Can I correct you, Kevin? So that's $2,000 is just for HOA walls out. They also carry an HO6 policy, which
That's what I was just saying. So when you, I don't know what your HO6 factor is, but it would be the difference of that $1,500. It's probably less than that. Or even if it is 1,500, do you want to give up the control for the same number? And that's what you guys need to determine. It doesn't matter to me which way you do it, regardless. I just think as a community, this is a great meeting tonight because you're putting all of the potential options on the board. You've done some due diligence to look at truly what it would be in a different way. And from here, you have to make a decision. What we would suggest is make that decision prior to your insurance renewal coming up, because right now you would have to get with an attorney, draw up the language that you want to use, and then sign that into effect. And you would want to do it into effect basically the same day that the association's coverage is canceling, if you do want to change it to making unit owners responsible. Because once you bind the new policy, you're going to be subject to 25% minimum earned premium. So then you couldn't cancel at least for 3 months. And then they're going to short rate penalty you 10% on top of that if it's canceled early at least. So you might as well do more due diligence now, work with your attorneys if that's the route you want to go, and be ready to have it signed and implemented and done and delivered, and everybody doing it on themselves, effective the same date the association's coverage will end this year. Or the next renewal, or whenever you think that's the time you want to make it.
Perfect. So it is 8:37. Let's try to get Kevin out by 9 p.m. So those of you who've been listening, go ahead, feel free to unmute yourself. And if you have questions that Kevin can answer, if it's a question about whether or not we maintained our carports correctly, that's not to Kevin, that's to the board. But question that Kevin has presented and that he can answer.
This is Glenda, and I have a question. Kevin, do you know of HOAs who have done this? Have you worked with them?
So I'm actually located in Houston, and I would tell you that I would love to see the 10 to 12% increases that Elena showed to you guys earlier today. This past year in 2023, we have delivered nothing but bad news. We were the bearer of bad news. Everybody was changing assessments. Houston and surrounding was seeing 100 to 500% increases. So nothing in comparison to what you're seeing in the Dallas-Fort Worth area or even Austin. You're still seeing some increases, but it's modest in comparison to coastal communities. So
Well,
yes, we have seen a lot of townhomes look at restructuring their coverage. But again, it all depends on the community. Same with a deductible buyback. And I gave you it could cost you $20 to $30 to go and get 50 or 100,000 of loss assessment coverage on your personal lines, or you could do the deductible buyback if it was 46 grand and your 46 units, $1,000 a piece. There's some boards that don't have the belief and trust in their residents and their community, and they would rather pay the money at the association level. There's others that are completely comfortable with the demographics of the community, that they feel everybody is responsible enough to go out and do this on their own and not diminish the value of the community. And that's really one of the other deciding factors at the end of the day is, do you believe you and everybody on here and those that haven't attended are going to do the right thing?
Okay, any other questions? Well, if there is no other questions, Kevin, I owe you a coffee. I do not know how to deliver coffee to you, but I owe you maybe more than one coffee. But thank you so much. So this is my understanding that you are going to be the agent, the primary agent for us.
I'm sorry, Elena. I
Yeah.
have a question. Are we gonna receive all the copies because it's a lot of information you guys.
Correct. So this meeting has been recorded. So you're going to receive a video of it, number one. But number two, Kevin, if you wouldn't mind, just send me what the document that you presented.
Of course, yeah.
And I will send you the documents that both, we showed you a spreadsheet with the approximate cost of coverage, and also I will send you the presentation that I shared. So yes, you will receive copies of everything.
And would you send us copies of what your husband put together.
Yeah, that's what I said. Everything, every document that was flashed on the screen today, you're going to receive a copy of.
Okay.
One thing I wanted to mention as well, you've seen some steep increases in Houston. We've, over the last several years, Elena, correct me if I'm wrong, but we've seen some pretty hefty steps as well. Really surprised us, in fact, and caught us off guard.
Correct. In 1 year, we went almost like 29% increase. That was our highest increase year over year. After that, it evened out. So we had 1 year when we had 29% increase, and after that was between 11 and 17% increases.
So my personal lines insurance just renewed 10/15, and again, I'm in a single family home. It doubled, 100%
Doubled.
increase, and that I use Travelers,
Ouch.
but no different than State Farm or Farmers or any of that.
But you're in Houston, so he has different headaches to worry about than DFW. Okay.
Yeah, I saw
Susan.
the other thing I would add really quick is if you do make the changes to make unit owners responsible, what we have typically seen too is now you're changing the documents from a maintenance standpoint, because there's no reason, if you're not going to be responsible to insure it, to continue to collect funds from a maintenance perspective. So
Correct.
now the roofs that you're talking about are going to become the unit owner's responsibility to either repair or look at maybe potential coverage through their personal lines from a loss that way with a more potentially reasonable deductible.
Correct. So what we're looking at potentially, if the numbers look, because we don't know what your numbers, maybe by the time you finish collecting quotes, it will be clear as the day that it was 50% increase in our premiums, et cetera, et cetera. So until we finish collecting that quote, there is no point of trying to guess it. But let's just say that we are kind of like similar, right? It's dollar to dollar. Either maintain HOA or maintain or start with the individual. Yes, if we were to switch to individual policies, then there would be no need for the HOA to collect 281 that is currently collecting. It would then collect maybe $70 because we don't need. So right now, how much are we spending for insurance per month out of your pocket? So you're paying 281, and I think that we're spending about 220 out of that on insurance. So to me, if we're no longer need to spend 220 on insurance, then we can drop our dues. Does that make sense?
And the bottom line for you to be able to keep up with these roof leaks and such is to be able to file a claim and have a reasonable enough
correct.
deductible.
So the main reason why I'm going to start this conversation is because my frustration with the fact that I cannot file a single claim for the last 8 years. Every single roof repair, we had to figure out the interior, we had to figure, like, we as a board had to figure out the materials. I mean, that is a lot of work for the board. And not to mention the cost. And all of this time, all I'm doing is writing checks to insurance. So first I write check to insurance, and then I called the roofer and said, sorry, Sam, can't pay you today. I just paid the insurance. So you don't have to wait.
Well, we're still gonna have to maintain the roofs or the insurance won't cover it.
Correct, but the point is that when you have an individual coverage, and I'm not advocating for or against it, I'm collecting data. I'm very scientific in that approach. If you are, as an individual owner, let's just say right now, decide that you switch to individual coverage, then you would, let's just say that at this point, I think that we would have potentially on some roofs enough damage that we could trigger a claim, for example, right? And if we trigger a claim and you get a brand new roof, brand new gutters, whatever the case, I don't know what it's going to look like. Then from that point on, maintaining that new roof will be easier than maintaining an 11 or 12 or 15 or 20 years old roof. There's just nothing we can do, just like a human. You can pour all the money in the world into a 25 years old roof and it's still going to continue to leak. Like there is just nothing you can do about it. It's like a tire on your car. You know, at some point you just have to toss it. And
at some point in time, you're going to have to buy a new roof.
Correct, but if we continue on the path that we currently do, there is no way for us to do it because every single penny is spent on paying paying a monthly payment that does not help us in any way. So when I spend a penny, I want that penny to do something for me. This is just very egoistical of me, but when I spend a penny, I'm asking this penny, what did you do for me? In this particular case, I'm looking at $6,300 and I'm asking the $6,300, what did you do for me? Because now I'm sitting here with 3 roofers in front of me, trying to figure out which one of them I can afford to pay today, on top of paying. So to me, it's more about the usage that I get out of the money. Let's just say that in opportunity A, option A, I have to pay $2,200, $220 per month. And that $220 per month gives me absolute zero. Give me absolute zero because
If we went to an individual insurance company
yes,
and everybody, it would have to be with the same insurance company.
Potentially.
Otherwise, we would have all these other problems.
potentially. So there is 2 questions to solve. Question of what, question of why, and question of how. So first, I need to answer the question of why. Why are we changing? What is the driving force of this change? The
Cost.
second question is what? What are my options? And the third question is how. How comes from why first, and then comes, so first you do a strategy, then you do a tactic. So you're keep asking me about tactic when I don't know what the strategy is. That makes sense? So to me, if I select a strategy, then the how comes as I go. You step by step, you start to call, you start to request quotes, whatever. But if I don't know what or why, then all these questions right now bouncing off me because I don't have the answers for them yet. So first, we need to understand why.
I think we're on step 1 is
Okay.
cost.
Cost. Okay, so cost, we're kind of looked at it. Well, we don't have side by side yet. We have side number 2 right now, but we don't have a side number 1 right now, which is Kevin is going to provide to us. The how do we make sure that Joyce and Sam and Bam and Terrell are all going to be able to replace, if they're together under one roof, all going to be able to make a smooth repair? That's a how. And to me, how comes after what? So first, I need the HOA to say what. Elena, do this for me. And then how do we manage the small details, logistics? So yes.
This is Glenda again. To me, it seems like the first question we should say, if we are deciding that we want to make individuals responsible, we need to say why. To
Correct.
me,
Why do we do
why we're considering doing this when there are so many cons attached to it.
Correct, because we have a one big
cost.
Correct, because with the individual insurance, we have 100 little cons. 100 little cons. And with the collective insurance, we have only one big con. And that big con is that I cannot use it.
No,
there's 2 cons there. It's going to be cost and the fact that
well, cost and not being able to use it. But Kevin, do you think that you can make, because it's 8:49 and I respect people's personal time.
Okay.
No, I'm good. I think you're all talking about the same thing. I would agree. Your perspective on it is I wouldn't say it's self-insurance. I would call it catastrophic insurance. At a 3% deductible and 240,000.
And a depreciation, it is a catastrophic insurance.
If that's a factor, yeah, it is a lot of money. Now, I also have a community not far from y'all that sustained 17.5 million in damage from a tornado with all the roofs torn off and 6 buildings completely destroyed. So in that case, $240,000 deductible to replace your community is great insurance. Mm-hmm. But I understand what you're saying on the day-to-day roof maintenance leak issues. It's not going to respond there if you're under that deductible. But if a vehicle or a fire happens, you're back to a $25,000 deductible. And some carriers are still offering lower than that. So it just depends. And then,
but you see, to me, property insurance. So when we talk about HOA insurance, we talk about as if there was one insurance, right? And there is not one insurance. Within that $6,300 payment that we pay each month. How many total policies do we have? Property, EON, what else? 5 more, I think.
Yeah, general liability, hard
Yeah.
non-owned auto
yeah.
liability, crime, work comp, D&O, and excess
Correct.
liability.
Correct. So just because we're talking about wind and hail right now, doesn't mean that all of those other insurances we're not talking about them right now. They still need to be maintained.
I
Yes,
do have
you
a
would still keep
question
all of
for
those.
Kevin. Is there an insurance company that would cover all of those instead of having all those different policies?
No, you wouldn't want to do that. There's certain carriers that do directors and officers liability really well that don't do general liability as well, or vice versa. So our philosophy is finding you the best coverage, terms and conditions, and pricing, and then coming to you to make the educated decision from there on what you think is best for your community. And so we don't have any carriers that offer all of them because there's deficiencies in those types of products. And
So
there's no
The
there's no
reason I
cost
ask
savings.
that is because I know you get on my personal homeowner's insurance and my car insurance is with the same insurance company, and I get a discount because of that. And that
Yeah.
was just that
There's
was
no
what the
there's no discount double
question
check on
generated
commercial.
from.
So
But good
apparently
question.
different type of insurance companies specialize in certain types of coverages.
Yes, ma'am.
Okay. All right. Any questions? Any other questions to Kevin? All right. I think that means that I still owe you all those coffees. We'll figure it out. Venmo
Yes.
you, Starbucks stocks or something. But go ahead and start collecting everything. Whatever you need from me, keep reminding me. I'm going to get the losses from Eric as soon as he
That's the last piece at this point is the loss runs, and then if he has a statement of values outside of what I already built, if he has one that breaks it down. If not, I can see if we can find it on the CAD website. I just haven't gone into that yet because it didn't make sense to if you were going to change your declarations, obviously. So loss runs, and then we'll get you the letters and we'll go from there.
Sound like a plan. Enjoy
Well, we're
your
going to have
evening.
to explore what needs to be changed in the bylaws to be able to facilitate
Yeah,
this
we would
if
need
we
to-
move forward on
Who's
it.
y'all's attorney?
We do have an attorney, yes.
What attorney do you use?
So she actually we found an attorney when we had a lawsuit against us, so I'm not sure if she is the best person. So if you have an attorney that
do.
looks at insurance, then we would be glad to take a referral.
Yeah, I can send you a referral.
Because she's a bankruptcy attorney and she is an attorney that deals with lawsuits against board of directors.
Elena, you're saying that the board has an attorney?
No, we do not maintain her, we don't pay her a retainer, but do we have an attorney who represented us in the past and spent a lot of time looking at our bylaws? Yes.
Can
Do
you
we-
give us the name of that person?
Yeah, she was the same attorney who did our bankruptcy.
Well, who is that?
Her name is Joyce. I don't remember her last name, but I can find that information. So I haven't even spoken with her in several years, but I hope she's still around. All right. Thank you, Kevin.
Thank you all.
You guys can stay. Kevin is logging on, but you can stay and ask me any questions that we haven't finished talking about. Thank you, Kevin.
Thank you. Y'all take care. Talk to you soon.
Mhm.
Thank you.
Any questions?
Hi, Elena. This is personal question. I remember on my seer, the other room, my sunroom,
Okay.
they have hole. The
Can you-
insurance is gonna
can you-
cover.
Can you start from the beginning? There was an echo.
Okay, can you hear me now?
Let me mute a couple of people so it's less echoey on my side. Hey guys, if I'm muting you, I'm not trying to be mean. I just try to hear her better. What's up?
Okay, can you hear me now?
I hear you better now. Yes.
Okay. On summer in the other room, my sunroom, in
Yes.
the theory is
Repair
it
and
have a
replace?
hole. Remember I sent you the picture?
I believe it has been. Let me double check because I believe that all those old ones have been cleared. But let me double check because Sarina, who is not here, was the one who kept track of all the roof repairs.
Okay.
Did
okay.
it leak since then? Have you
Uh,
had any leaks since then?
No, I mean, the leak is all stopped right now, but the maintenance things, the insurance is gonna cover, or
What do you mean the insurance?
the hole
The
inside
hole-
the room? Uh-huh.
The hole inside the roof, I believe that has been fixed. So exterior repairs, I believe yours is one of the older ones, I believe, and I will have to double check if you would text me. But Serena showed that we finished working on your unit.
Okay,
Okay,
thank you.
but if you would just text me at the end of the meeting. Any other questions?
I will. I know. Thank you.
Oh, Fahim, you raised your hand. Go ahead. I don't know if you meant to raise your hand. Oh no, you didn't raise your hand. Okay, sorry. It looked like a raised hand. Any
Elena, is this considered a board meeting?
No, we don't even have a quorum.
I wondered about that.
No. It was purely a brainstorming educational. It's not a board meeting. I'm not taking notes. I'm not, we don't have an agenda, so to speak. Any other questions? Okay, well, so it's, I'm going to let me go ahead and stop sharing or stop recording so we don't spend more, it goes onto my computer, so it's going to be a huge file.